I would like to introduce Chris Manser from SwissLife Asset Managers. Chris has been responsible for SwissLife's infrastructure business since May of 2012. Prior to joining SwissLife, he was at AXA for 5 years, where he was also a member of the firm's Global Executive Committee, responsible for about $6 billion hedge fund. Prior to that, he was the head of alternative investment at Winterthur Group and Credit Suisse Financial Services for about a $5 billion private equity and hedge fund portfolio. He started his career at UBS, and he's a graduate of physics from ETH Zurich. He's a CFA charter holder. And just a word about SwissLife. SwissLife is about 150 years experience in asset management, over 200 billion in assets, a lot of infrastructure and real estate, and 2.5 billion is focusing on minority investment in infrastructure in OECD, which includes utilities, transportation, renewable energy, telecom, water, and other assets in Europe and North America. Chris.
Thanks, Reza. Good morning, everyone. Just one second. Technology. Good morning, everyone. It's a great pleasure to be here this morning as a bit of an exotic presenter. As Reza mentioned, it's a bit of a homecoming for me. Actually, I took my first analysis lecture about 25 years ago, a bit more than that, just down the hallway. So it's a great pleasure to be here, actually, in the Audimax today and talk about what how an institutional investor like SwissLife is investing in the infrastructure space and why. So basically, just a couple of or a few words actually about SwissLife Asset Managers. Reza already mentioned it's part of SwissLife, which is a large insurance company based in Switzerland. SwissLife Asset Managers has is overall the third largest asset manager, institutional asset manager in Switzerland. It is actually the number one player in the European real estate space. We're about 1,500 employees, and we have about and the 200 billion of assets under management are split. 3/4 balance sheet assets, so that's money we manage on behalf of insurance policy holders on the balance sheet, and then we have another quarter, a bit more than 50 billion of assets under management from third parties. It's actually this third-party asset management part that has been growing most over the last several years, whereas the the balance sheet has been relatively stable. You can see a typical asset split on the upper left-hand side, typical for an insurance company, so dominated by fixed income, about 2/3 of fixed income. Then we have a bit, I would say larger than normal allocation to real estate. And I guess that's the reason why we started to invest also into the infrastructure space. But with over 20%, that's a very significant allocation. And then we have some listed equities, just about 10%, and not a lot of other things. Also quite atypical for insurance companies not to have a lot of alternative investments and more exotic investments. For us, that's a couple of percent. And that's actually where in the alternative space, that's actually where the infrastructure allocation sits. To be a bit more specific about our infrastructure business, as Reza said, I joined more than 5 years ago, established the team and the strategy. And since about 5 years, we're really operational, making investments. Today, we have about $2.5 billion euros under management. And we manage that with a team of 15 people, whereof 12 are investment professionals. We manage 3 infrastructure vehicles, and these 3 infrastructure funds have made a total of 16 direct deals, and we also invest a small amount of money into funds, but predominantly we are a direct investor in infrastructure assets. These infrastructure assets you can see on the right-hand side are well diversified along sectors and are predominantly Europe and North America. Just to make a couple of examples, actually we own some of the assets that were depicted in Reza's presentation, just as tiny lines when it comes to grid assets, or dots when it comes to power generation assets. So for example, we own a gas distribution company in the north of Spain. So they distribute gas to the households and industrial and commercial customers. We also own a electrical transmission system operator in Germany. So that was a line on the electrical grid. And we also own a few lines on the transmission grid Reza showed on the gas side. So one in Italy, and then on the power generation side, it's mostly renewables. So we have a few assets, as you can see on the chart shown. So let's maybe first talk about why institutional investors are looking at infrastructure. And to understand that, you have to understand that insurance companies and pension funds, for the same matter, have liabilities. So they've taken in money, which they manage, and often they actually had to provide guarantees that they provide ongoing guarantees, like minimum returns on these assets. So the goal is really that the asset side, the investments outperform the liability side, because that's then that translates itself into a profit. Now, given the low interest rate environment that we've been having since the great financial crisis, this has become more and more difficult because fixed income has just not been able to yield as much as in the past. So the solution is, a simple solution would be to increase the level of risk taking and hope that with the increased level of risk, your returns are also increasing. Now, unfortunately, it's not that simple, because as an insurance company, but also some, to a certain extent, pension funds are regulated. The European regulation is called Solvency II. Here in Switzerland, we have a similar one, which is called Swiss Solvency Test. And basically, this regulation means that for every asset class you're holding, you have to put capital aside. Depending on the risk profile, if the asset is riskier, you have to put more capital behind an investment. And basically that forces institutional investors to take a risk-adjusted return on risk capital view. So the question is, where do I get the most bang for my buck in terms of, and the buck would here be the risk capital that I have available. It happens that infrastructure actually has a very favorable treatment with respect to these solvency requirements. Hence, the additional return that you need for the asset class is relatively low compared to maybe other asset classes that have a similar risk profile. And that is one reason. It's certainly not the only reason, but it's one reason why in this low interest rate environment, infrastructure provides a way, a convenient, an efficient way for institutional investors to generate higher returns, which they need for servicing their liabilities without taking excess risk. So that's sort of the reasoning why people are going in, and then do we actually see this in the market? And yes, we see that. If you look at the right-hand side, if you look at the number of transactions, it has clearly been growing since the end of the great financial crisis. You also see it in terms of assets under management. Infrastructure funds around the world are ever managing more capital on behalf of institutional investors. So that's the middle chart. It shows a staggering growth. And as a corollary to that, you also see at the bottom chart that the dry powder, so the money that actually hasn't been put to work, is also growing. And that shows all of this basically shows and evidences the fact that the appetite for infrastructure assets has grown and is continuing to grow, and I think that trend is not going to change much. So just quickly on the supply side, we've covered the demand side. The supply side is great. The good news is, and we've also heard that from Reza, the world needs infrastructure. If you actually look at this study, it's a McKinsey study from 2015. Basically, the world needs about 5 trillion per year, and that's well split between transportation, power, utilities, including water and telecoms. Unfortunately, fortunately for a private investor, of course, but the governments often don't have the funding. So there is really a requirement to fund these projects on a private basis. And hence, I strongly believe that the supply side, even in countries where maybe the private sector participation has been relatively slow or slowly growing, like in the US, it's going to happen, and private capital in infrastructure is going to further increase from here. Next, also very briefly, just a couple of definitions, because over the last 5 years I found out that everyone has a slightly different definition of what is infrastructure. Sometimes I think almost everything is infrastructure or called infrastructure, but we have a more stringent definition where we basically, where we say it has to be an essential service. It has to be backed by assets. For example, a service company in the infrastructure space wouldn't qualify as infrastructure for us. And we really need high barriers to entry and limited competition for us to be comfortable investing into an infrastructure business. The lower part talks about the different strategies when it comes to risk in infrastructure investments. It comes actually from the real estate side, so if you're familiar with that, it's pretty similar. It starts with core, so core is the lowest risk sector. Goes to core plus, where businesses are a little bit more risky, but still obviously fulfill the definitions and the criteria for infrastructure, and then goes into value add / private equity, which then is really the risky end, where also, if you look at returns, obviously then we're talking about mid-teen, could be up to 20% returns, whereas in the core space, and generally the space where we are focusing on, we're talking about sub 10% returns, so starting probably as low as 6%, going up to 10%. And Another reason we haven't talked about why an asset class like infrastructure is good for insurance companies in particular, but institutional investors in general, is the ability to generate dividend yield. So the dividend yield aspect, if you look at this risk-return chart here, is the lower the risk, the higher the cash yields, so the better for us again. The higher the risk, if you go into value add and private equity, clearly dividend yield is no longer much of a topic. It's about capital gains, and hence it's for that reason also less attractive for us. So we are really focusing on the lower end of the risk spectrum. And moving on, I think you'll hear that and you'll realize and hear about some reasons why that is the case. So on the next 3 slides, I'd like to focus and explain to you how we look at specific subsectors. I picked the 3 subsectors which I thought were most relevant to the audience. So we're going to talk about power generation, oil and gas, and aviation. And I'm going to focus just on the key sectors in order to not use up too much of my time. So on the power generation sector, the most important one for us and the one that we've been putting money to work is the renewable energy sector. But there are not all renewable energy projects are made the same. So that's why I said, what do we actually like? What is an issue? What don't we like? And what are we sort of okay with? So on the renewable side, what we like are feed-in tariffs, so subsidies. We're probably not the only one liking that. And we like projects that have long-term PPAs. So it's all about stability, it's about de-risking, and actually not to be exposed to merchant power risk. On the power price side, we tend to be very conservative, also compared to our peers. We don't feel ourselves to be very qualified to forecast power prices 20 years out. So we try to err on the more on the conservative side, and sometimes that's an issue if a project is fully merchant or has a relatively short period with PPAs or other contracts. We don't like development risks, so the project has to be relatively well defined already before we engage. But we can take construction risk, and we're definitely okay with O&M risks. And also we've looked at offshore. We haven't invested actually, but we have looked and have gotten comfortable in the past on offshore. Although I have to say a combination probably of construction risk and in an offshore asset, it might be a little bit too much for us. Moving on to the gas-fired side, we haven't been successful there, but it's definitely we're definitely looking at projects. They're quite similar to the renewable space. We like contracts, we like PPAs or tolling arrangements to de-risk an asset. And again, just to make the analogy, but we're not asking for let's say mid-teen returns. So if an asset is de-risked, then we think we have very good cost of capital and very attractive cost of capital for sellers. I'll leave it there and move on to the next subsector, the oil and gas subsector. So I would differentiate between downstream, midstream, and upstream. Upstream is really not for us. We don't want to have commodity risk. We're just not the bucket in the asset allocation that would take commodity risk to the extent the company or a similar company would have appetite, then they will probably play it elsewhere. And on the downstream side, usually the business risks are also a bit too high for us to engage. So if it's a small, if an integrated utility has a small supply side business, then that's fine. But we don't want to engage if that's a major component or major part of the business. So midstream is really the sector where we are focusing on, and the key subsectors there are regulated gas transmission and distribution companies. And as I said in the introduction, we have made some investments in that space, both on the distribution and on the transmission side. We are also interested in storage asset. Can be liquid bulk storage assets, could be in theory also gas storage assets. But we also like long-term contracts, typically in the form of take-or-pay contracts. We have issues with, as I already said, commodity price risk. We're not qualified to forecast commodity prices. We like to reduce volume risk as much as possible, hence why we're focusing on long-term take-or-pay contracts, and also resource assessments or deals or assets where there is a resource risk attached to it are probably not the right fit for us. Yeah, I think that probably says most of it on the oil and gas side. Let's move on to the aviation side. On the so here we have I would say we have four main sectors. One, at least the relevant ones for financing activities. One is equipment leasing. So far we've not been looking at equipment leasing for a simple reason. We couldn't get comfortable with the releasing risks or residual value risks, and the sort of probably coming from the technology risk. Then airports, which is our key focus in this subsector, and then airlines would, in theory, be a possibility, but there the commercial risks are too high for us, and hence we're not looking at it. And then there are others like traffic control, for example, although that's a pure service business. But there has at least have been transactions where infrastructure investors have been involved in the past. So I wouldn't rule it completely out, but maybe, I mean, clearly not the key focus. So on the airport side, which is the key focus, we like regulated airports, large capital city airports, also regional airports, and we're absolutely okay with the non-aeronautical activities like shops and retail shops and car parks, which are common at airports. So that's absolutely fine for us. We don't like development risks. So if there is, for example, a new runway planned without the appropriate approvals yet, it's probably not for us. But we're generally very supportive of CapEx programs, which most of these airports have, because as we all know, air traffic is growing significantly, and a lot of these airports are running out of capacity. So so CapEx is definitely fine for us. I would say it's actually even attractive for us as a driver of returns. So where we're a bit cautious is generally on passenger growth. Again, trying to be on the conservative side, not on the very aggressive side. We're also rather cautious on overall aeronautical revenues, while passenger growth will continue to rise. Not sure per passenger aeronautical revenues will keep pace. And then on the car parking side, I think there is also we try to be rather conservative, thinking that at some point autonomous vehicles might be affecting car parking or the need for car parking also at airports, and hence reduce revenues or at least not or keep them from continuing to grow. So these were the sort of the three subsectors I wanted to use to show you a little bit more how we look at how we behave as investors, what is important for us, what the key risks are. On this slide, I'd like to talk about how we partner, because given that we're only taking minority interests in businesses, we almost always partner with someone. And given that we have a very conservative approach to the asset class, actually partnering also helps us further mitigate the risks that we see in the business. So we start with the very low risk side. That could be an operating regulated utility asset that has been there for a few years and is quite stable. So we would actually feel confident and comfortable pursuing that opportunity on our own or together with a like-minded institutional investor. We've been doing that for the last 5 years and will continue to that. When we move up the risk spectrum and sort of start incurring some business risk, maybe also some execution risks, maybe it's a carve-out from a larger corporation, then we actually like to get additional expertise. The additional expertise could come from a specialized infrastructure fund, so a fund that has already managed an asset in the specific space, or it could actually be a strategic partner, so a obviously true specialist in the sector. And then if we move further up the risk spectrum, then I think for us it will become a must to be able to partner with a strategic investor. Partnering with a strategic investor can come in two flavors. The first one being buying a minority from a strategic investor to lighten up that company's balance sheet, or teaming up with a strategic investor in order to jointly pursue an opportunity. So to make an example, last year we've joined forces with a strategic investor in the telecom space to buy a portfolio of telecom towers here in Switzerland. So we didn't feel comfortable doing that on our own because there is a lot of experience involved in managing, in assessing, but then most importantly managing these telecom assets. We've teamed up, and the strategic partner took 51% or over 50%, and we took roughly 30% interest, and then there was a third financial partner involved in the transaction as well for the remainder. Just to make an example. Now, I mean, obviously it's good for us to work together with strategics, but I think there are also benefits to strategic investors. We are what we believe, or we look at ourselves as being friendly long-term capital. We are quite flexible in terms of governance. So in the example that I've made, we were flexible enough to allow the strategic to consolidate the asset on its balance sheet. And I've already mentioned, I think we have quite attractive cost of capital. We want to be remunerated for the risks that we're taking, but overall, we have competitive cost of capital. So to summarize everything, and again, I think that is particularly obviously true for SwissLife, SwissLife Asset Managers as a infrastructure investor, but I think it's to some extent also true for generally for institutional investors acting in the space. We have a long-term buy and hold approach. which obviously suits very well the nature of the underlying businesses, which are long-term businesses. And it also suits our partners and other stakeholders. We look at ourselves as generalists. That's why we like to work together with experts. Obviously, we are getting experts in the process, but it's definitely great for us to partner with experts. However, we're also we're engaging in a transaction and also then on an ongoing basis within the limits of our governance. We have very strong investment appetite, so the company has already put quite some money into the space and will continue to do so, as this is a very attractive asset class with the potential to provide very good returns. And then maybe the last thing on risk, I'd like to leave you with sort of the view that we are conservative, hence we focus on the lower end of the risk spectrum, but we're very risk conscious, really try to get behind the risks that we're taking. Some of them we can manage actively, and some of them we have to actually take, and then you should always make sure that the risks that you ultimately have to accept are acceptable risks and you get compensated for. So thank you very much for your attention.
Thank you very much.
No questions, right? Questions?
Any one question? Two? No? Any questions? Yes, Jörg.
Jörg Säumer, Leibniz University in Germany. One of the basic assumptions underlying your business model is that you have a high evaluation of infrastructure assets in the low risk category of your capital assessment. All of that, the European rule that was under
Solvency II.
Sorry.
Solvency II.
Solvency II.
Mm-hmm.
Thank you. Won't that change dramatically now? I mean, when I look at yesterday, Uniper was sold off to Fortum. Power generation assets in Germany were sold off to Fortum for below market value because they wanted to get rid of it. Isn't that assumption? Is that assumption still tenable? The assumption that infrastructure risks are low under these solvency rules.
Well, I don't think it's going to change. I think for two reasons. First of all, I truly believe that if you invest properly, that the risks are actually lower. And secondly, I think the politicians have also realized that it's good for them to make investments into infrastructure attractive. However, a company like Uniper, if you make that example, actually would not have the same attractive capital treatment as a sort of a single, a single, let's say, renewable asset that receives a feed-in tariff or a regulated, 100% regulated utility. So there are clear rules. Only only qualifying assets. There are a set of rules, and if an asset qualifies for these rules, then you get the favorable treatment. And the rules are all around stability of revenues and costs, basically. And the regulated, and that's why, for example, regulated businesses are qualifying, because the regulator, obviously, the way tariffs are set, obviously you get a stack of revenues, you get your costs basically reimbursed, you get your debt financing costs reimbursed, depreciation you get reimbursed, and then you also get a return on equity. And all of that determines your revenue requirement. And there is not that many moving parts. And that's why that is a qualifying asset, but then the Uniper, with its generation assets, would generally not qualify for the same low capital charge.
Well, thank you very much, Chris, for